Okay, now come to the next paragraph. Next paragraph is difference in reporting dates. Can subsidiary company have different reporting date? Ideally, no. But sometimes due to practical requirement, it can be yes also. And this usually happens when parent and subsidiary are in different countries. Okay. Parent may be in USA, so year ending date may be 31st December. Subsidiary may be in India, so year ending date will be 31st March. So ideally the CFS should be prepared on the same reporting date. If different, then adjustment for significant event and transaction between the two dates shall be made. So here again the examiner can test you. They can give you two different dates, one 31st March, one 31st December, and they may give you some transaction between these two dates. So you have to update the financial statement of the subsidiary. After considering those transactions, prepare fresh statement of financial position and then use that for the purpose of consolidation. In any case, what the standard says, the difference should not be for more than 3 months. Whose financial should end first? Subsidiary. Whose financial year ending date should be end first? Subsidiary. Because the difference should not be 3 months, can be interpreted like this also. Parent year ending date is 31st March. So whether 3 months on this side, that is 31st December, or 3 months on this side previously, because otherwise parent will have to wait till 30th June, and subsidiary is not going to give you the financial statement on 30th June itself. They will take another few months to complete. So practically this will be the year ending date of subsidiary, and they will hand over their financial to you somewhere before 31st March. Any transaction between these two dates will be adjusted. Intra-group transaction. So now we'll have a special discussion on intra-group transaction. If there are intra-group balances, eliminate. Like in two problems we did that, loan. Now we will discuss intra-group transaction resulting into unrealized profit or loss. So on that you will have a lot of adjustments in the exam. So one adjustment you can easily understand will come from this section, intra-group elimination of unrealized profit or loss. In the consolidated financial statement, unrealized profit will be eliminated in full. Unrealized loss will also be eliminated unless the cost cannot be recovered. That means if the value of the asset itself has gone down, then we don't need to reverse the loss. But if the market value is higher than the cost, then we have to reverse the loss. For transaction between group enterprises, unrealized profit resulting from intra-group transactions that are included in the carrying amount of the assets such as inventories and tangible fixed assets are eliminated in full. Now, one effect will be in SOFP. Suppose SOFP has inventory. So eliminate 100% unrealized profit from inventory. The question is, where is the second effect? Second effect depends on whether subsidiary has sold to the parent or parent has sold to the subsidiary. So requirement to eliminate such profit in full applies to transactions of all subsidiaries that are consolidated, even those in which group interest is less than 100%. Since we are recording 100% of the net asset, we will eliminate 100% of the unrealized profit from SOFP. Only second effect I am going to explain below. How the second effect will be given. from where that unrealized profit will be eliminated. One, reduce from inventory. Second, check whether it is upstream or a downstream transaction. In your note I have written upstream, downstream. Point 1, upstream means subsidiary to parent. So downstream means parent to subsidiary. Now understand, in case of upstream transactions, goods are sold by subsidiary to holding company. Okay. Who has made the profit? Subsidiary. Subsidiary's profit is distributed between whom? Parent and NCI. Parent and NCI. So therefore, if I have to eliminate the profit which is earned by subsidiary, I will eliminate it from those who have benefited from that profit. So parent share will be eliminated from consolidated profit and NCI share will be eliminated from NCI total. Okay, that is for upstream. What about downstream? In a downstream transaction, holding company is the seller and subsidiary is the buyer. So parent sells to subsidiary. Parent sells to subsidiary. So who has made the profit? Parent. Where is the profit sitting? In the consolidated P&L account. Did non-controlling interest get a stake in that profit? No. So when I am going to eliminate the profit from the group financial statement, it is the parent profit and loss, that is consolidated P&L account only, that needs to be adjusted. NCI share should not be adjusted here. Okay. So the summary of discussion is, in case of downstream, whole profit is earned by holding company, that is parent company. Therefore, whole unrealized profit should be adjusted from unsold inventory. Second effect, consolidated profit and loss, irrespective of the percentage of share held by the parent. Now see, there is a small summary also. Unrealized profit on stock, upstream, downstream. Upstream, sold by subsidiary to other member of the group. Downstream, sold by parent to the other member of the group. Adjustment entry. Suppose I am preparing the CFS, or let me say I am preparing consolidated SOFP. I am only asked to prepare consolidated SOFP. Okay. If I am asked to prepare consolidated profit and loss, then I will give adjustment in cost of goods sold also. I will tell you that later. Now I am asked to prepare only consolidated SOFP. If it is an upstream transaction, I will reduce it. One effect, P&L account of subsidiary company debit, and second effect, inventory. Second effect, inventory. So what will happen? Automatically, when the subsidiary's profit gets reduced, it will automatically get distributed between parent and NCI. Okay. Okay. If there is a tax adjustment also given, if there is a tax adjustment also given, then in that case I am going to debit deferred tax asset account. Why DT account we have discussed. The carrying amount is reduced when you reverse the unrealized profit, but tax base does not get reduced. So tax base is greater than carrying amount. IS 12 is applicable. It will give rise to DTA, deferred tax asset, deductible temporary difference, which means DTA. And if it is a downstream transaction, profit and loss of parent debit means reduce it from here to inventory. So NCI will not get affected. And again, in some question which we are going to solve, they may give tax adjustment also. So deferred tax asset account debit. Is it right? So the summary of this last page is as follows. P&L account of parent will be adjusted in retained earning of the group. So when you are preparing the SOFP, reduce it from retained earning. In statement of profit, if statement of profit is also prepared, now there will be questions like this: prepare only SOFP, then this treatment will give. Reduce from inventory, reduce from retained earning. In case of upstream, reduce from NCI also. But if you are also required to prepare the statement of profit and loss, then the unrealized profit will be adjusted in the cost of sale. What is cost of sale? Formula for cost of sale: opening stock plus purchase minus closing stock. Now closing stock I am adjusting. So if I am adjusting the closing stock, which means my cost of sale will also be adjusted. Is it right? So if you are asked to prepare SOPL, which I am going to take in some questions so that you will understand, you have to give the adjustment of unrealized profit on inventory in the cost of goods sold also. Okay. Elimination of sale and purchase transaction will be done as usual in consolidated P&L account. Now whether there is unrealized profit or not, you have to eliminate intercompany sale and intercompany purchases. Some students think if there is no unrealized profit, no need to make adjustment in sale and purchase. Some students, they think if there is no unsold inventory, no need to make adjustment. This adjustment will be done in SOPL, irrespective of whether there is unrealized profit or not. Then elimination for sale and purchase will be done even if there is no closing stock held on the date of consolidation. Unrealized profit will be adjusted only for transaction made in post acquisition period. So what we will do, unrealized profit will be eliminated only for transaction made in the post acquisition period, because the control was acquired from this date of acquisition. So, and normally also most of the inventories are sold close to year ending date. So don't make adjustment for unrealized profit if the sale was made in the pre-acquisition period. Then deferred tax calculation will also be made on unrealized profit if you are given tax rate in the problem. Okay. Unrealized loss we have discussed. Unrealized loss will also be eliminated like unrealized profit. However, unrealized loss adjustment is not required if the cost cannot be recovered. If the cost cannot be recovered. So inventory cost 100, sold for 80, but its NRV is also 80 or less than 80. No adjustment required for unrealized profit, unrealized loss. But if the NRV is more, then we'll make adjustment. Okay. Now solve some simple example, and this will form part of your main question. And that one main question can go up to 50 marks also, 40 marks also. A parent owns 60% of the subsidiary. Subsidiary sells some inventory to the parent for rupees 35,000 and makes a profit of rupees 15,000 on the sale. The inventory is in parent's SOFP at the year end. So what is the treatment? This treatment is given in the form of an explanation. Reduce 100% of the unrealized profit on consolidation. So from inventory, how much I am going to eliminate? 15,000. So inventory will appear at 20,000. then income will also reduce by 15,000. Who has sold to whom? Subsidiary to parent. Now see the entry. This entry you will pass in case if you are also asked to prepare P&L account. Revenue account debit 35, because revenue includes 35. Then to cost of sale 20, and to inventory will reduce by 15. Inventory will reduce by 15. Cost of sale 20. Why we have reduced by 20? The purchase was included here. Purchase included in cost of sale is 20. So purchase I reduced by 20 and inventory I reduced by 15. Effect is same. You can pass any other combination of entry and it will have the same effect. For example, you can pass like this also. First you eliminate sale and purchase. So revenue account debit 35, but for one party it is purchase. Sale of one party is purchase of another party. And then you eliminate the unrealized profit. Eliminate the unrealized profit. So entry for elimination of unrealized profit will be cost of sale account debit to inventory account. Inventory I have to reduce. I have to reduce inventory. So inventory will be credited by 15. Do you agree? So second effect, your cost of sale will get adjusted by 15. Now what is the net effect in the cost of sale? Net effect in the cost of sale, purchases 35, this is 15. Purchase is reduced from cost of sale. Cost of sale you are crediting means your purchase you are crediting means cost of sale will reduce by 35. So the net effect in cost of sale will be 35 minus 15, 20, and this inventory 15 and this 35. Is it matching? So we can pass only one entry if required, or we can pass two entries. Whichever gives you more happiness, you can do it. Okay. Now since you are going to pass this entry, it will reduce the profit of the subsidiary by 15. It will reduce the profit of the subsidiary by 15, and then while allocating the profit of the subsidiary, automatically what will happen? 60% will be parent share and 40% will be NCI share. 60% will be adjusted in parent profit and 40% will be adjusted in NCI profit. Now in the above example, assume that parent has sold to the subsidiary. Rest of the details are same. So now in this case also we'll do the same thing. We'll reduce from the inventory 15,000, but we'll reduce the entire 15,000 from the consolidated profit and loss. So in this example, entire 15,000 will be reduced from parent of the parent's profit. So NCI will not get affected here. So when you are going to solve a bigger problem, this adjustment will come. Check upstream or downstream. If upstream, then while calculating NCI share, you have to adjust his share in that unrealized profit. If it is downstream, then do not adjust the NCI share in that unrealized profit. That much care you have to take. One more question. This time with the tax effect also. A parent company sells goods costing 200 lakh to its 80% subsidiary B Limited at 240 lakh. What is the profit they have earned in this deal? Dear student, they have earned 40 lakh overall profit. 50% of the goods are still in the stock. Means the unrealized profit lying in the stock is 20. B Limited has measured this inventory at cost at 120 lakh. Just make a check whether in your book 120 is written or 240 is written. Make it 120 because half of the stock is only remaining. So means 120 includes 20 profit. 120 includes 20 profit. Show the necessary adjustment in the CFS. Assume 30% tax rate. Is it upstream or downstream transaction? Parent company sold. So we will call it downstream transaction. First we will see how much unrealized profit from inventory will be eliminated. 120 minus 100. 20. Okay. Half of 40. This will increase expenses and reduce the consolidated profit by 20 lakh. So one effect will be in inventory 20 lakh. One effect will be in the profit of the parent 20 lakh. And then it shall also create deferred tax asset of 6 lakh. Why this deferred tax asset has come? 30% is the tax rate and 20 lakh is the difference between accounting base of inventory, that is 100 lakh, and its tax base, that is 120 lakh. So write down this answer. E Limited shall reduce the inventory of rupees 120 lakh you can just write A Limited shall reduce the inventory by rupees 20 lakh in CFS and reduce the consolidated profit by rupees 20 lakh. It should also create DTA of rupees 6 lakh. It shall also create DTA of rupees 6 lakh, that is 30% of 20 lakh. In bracket 30% of 20 lakh, since accounting base of inventory in bracket rupees 100 lakh is lower than its tax base in bracket rupees 120 lakh. Okay. Try one more. Ram Limited, a parent company, purchased goods, now this time upstream, costing 100 lakh from its 80% subsidiary Sham at 120 lakh. 50% of these goods are lying in the godown. Ram Limited has measured this inventory at cost, that is 60 lakh. Half of 120 lakh. For Ram, 60 is the cost. Okay. So how much unrealized profit is included here? Can you calculate? Total is 20. Half is sold. Half is unsold. So 10 is unrealized profit. Show the necessary adjustment in CFS. Assume 30% tax rate. Write down the same note. Ram Limited shall reduce the inventory by rupees 10 lakh. Ram Limited shall reduce the inventory by rupees 10 lakh in CFS. Ram Limited shall reduce the inventory by rupees 10 lakh in CFS. The reduction of group profit of rupees 10 lakh, the reduction of group profit of rupees 10 lakh is allocated between parent and NCI in the ratio of 8:2. In the ratio of 8:2. It shall also create DTA. It shall also create DTA of rupees 3 lakh. Why 3 lakh? 30% of 10 lakh. Since accounting base of inventory into bracket rupees 50 lakh is lower than its tax base in bracket rupees 60 lakhs. One more adjustment we'll discuss, because this will also come in several problems. Okay. Unrealized profit on transfer of non-current asset. Say for example, property, plant and equipment, also called fixed asset. So similar to treatment described above means like unrealized profit on inventory. Okay. Unrealized intercompany profit arising from intragroup transfer of PPE will be eliminated from CFS. Now here there is a small problem. Parent company sells PPE to subsidiary. It is similar to parent company selling inventory to subsidiary. But there is a small problem here. When subsidiary buys the PPE, it provides depreciation. Whereas in case of inventory, this depreciation issue was not there, right? So that time we can just identify how much is the unrealized profit and give the treatment. Now here I have to give two treatment. One, profit is earned by parent. Profit is included in that property, plant, equipment. Subsidiary has provided depreciation. Subsidiary has provided the depreciation. So depreciation is charged by the subsidiary. So I have to give the effect of now both these items. Parent company has earned the profit, that I will eliminate, and depreciation is charged by subsidiary. So we'll give the reverse effect of that also. So what entry we will pass now? First is eliminate unrealized profit from PPE. Parent has sold to subsidiary. Where is the profit sitting? Parent's book. So the entry will be group total retained earning account debit, means parent company's profit, to group PPE account. Profit is eliminated. Eliminate that additional depreciation which the subsidiary has charged. Additional means, suppose parent sold for 1000. Parent cost is 1000, sold for 1500. So they will provide depreciation on 1500. So which means depreciation on 500 is provided extra. In any case, as a group, we would have provided depreciation on 1000. So we will eliminate that additional depreciation. In whose book that additional depreciation is charged? And who has suffered because of that? Two parties, the parent and NCI. So now if you see, while solving the problem, be careful. If the subsidiary has passed depreciation, then it will be allocated between parent and NCI. So group PPE account debit for that additional depreciation charged to group total retained earning, parent share, and to NCI share. Okay. If the fixed assets are sold at a loss, entries will be reverse of the above. Normally most of the question we will solve is profit based only. But mentally keep in mind, if it is loss, the whole entries will get reversed. Second example. Sale by subsidiary to parent. Who has sold to whom? Subsidiary to parent. So where is the profit sitting? Subsidiary's book. Who enjoys the profit of subsidiary? Parent and NCI. So this time I am going to reduce parent share from the group total retained earning, and I am going to reduce the NCI to the extent of NCI share to group PPE account. And this time who has provided the additional depreciation? Parent. Is NCI going to bear any burden of this additional depreciation? No, that is in the books of parent. Only reverse that much additional depreciation. Group PPE account debit, increase it to group total retained earning. This is the reversal of additional depreciation charged. Is it right? Is it right? Yes. If the fixed assets are sold at a loss, above entries will be reversed. Second note, if the subsidiary is fully owned, there will be no NCI adjustment. Then it doesn't matter whether it is upstream or downstream. If there is no NCI. Now one more adjustment they may ask you to do. If you are going to eliminate the unrealized profit, yes or no? And if you are going to eliminate the additional depreciation that you have charged, it will give rise to a difference between carrying amount and the tax base. So therefore there will be a deferred tax adjustment also required. So the tax effect on elimination of profit on intra-group sale of asset must also be considered. Right? A temporary deductible difference has arisen because the tax base of the asset is higher than its carrying amount. So again understand, this is carrying amount, this is tax base. Sir, why carrying amount is lower? Because I have eliminated the unrealized profit. Is it right? So when I remove the profit component from the carrying amount, this portion gets eliminated. So carrying amount is lower than tax base. So on this portion we will have to create a deferred tax asset. Okay. The future taxable profits are lower than the consolidated accounting profit because the unrealized profit has already been recognized for tax purpose. The seller has already offered the sale of that asset for tax purpose. Here only for accounting purpose we are removing that unrealized profit. Government has already charged you the tax. In future you don't have to pay tax. So DTA entry is recognized. DTA account debit to group total retained earning account. And I have written one note, adjust in the profit of seller. So if it is parent company, adjust in the profit of the parent. If parent has sold. If the subsidiary has sold, adjust in the profit of subsidiary. And if you adjust in the profit of subsidiary, it will automatically get bifurcated between NCI and the parent. And in the subsequent year, the entity depreciates its fixed asset. So as and when you start depreciating the fixed asset and deduct the depreciation from the taxable income, following entry is made to unwind the DTA. Group total retained earning account debit, that is adjust in the profit of the buyer. Who is providing depreciation? The buyer. The buyer is charging more depreciation. Okay. So adjust in the profit of the buyer to deferred tax asset account. So deferred tax asset will be created in the books of the seller, and the effect of that depreciation will be adjusted in the books of the buyer. Now dividend will take a question immediately after the theory part. The first question deals with depreciation only. Okay, just wait for a minute. Now we'll discuss some issues relating to dividend. When is dividend recognized from subsidiary? First we'll apply IFRS 9. It says dividends are recognized by an investor only when the entity's right to receive the payment of dividend is established. It is probable that economic benefit associated with dividend will flow to the entity. And third, the amount of dividend can be measured reliably. Then we'll come to IAS 27. What does IAS 27 say? Same thing. An entity shall recognize a dividend from a subsidiary. IAS 27 deals with separate financial statement. In its separate financial statement, when its right to receive the dividend is established. When is an entity's right to receive the dividend established? The entity's right to receive the dividend is established when it is declared by the shareholders in the AGM of the company. Okay. In case of final dividend. In case of interim dividend, it is approved by the board. Now the main thing is, where will dividend be recognized? Dividend will be recognized in which statement? Profit and loss. Dividend will be recognized in profit and loss. Once it is proved that you are entitled to dividend, it will be recognized in profit and loss. One small example. And with this example, if you have any doubt, that will be cleared. XYZ purchased 80% share of ABC on 1420X1. The issued capital of ABC was 1 lakh, balance in the statement of profit and loss was 60,000. For the year ending 31st March 20X2, ABC Limited has earned a profit of rupees 20,000 and at the same time declared and paid a dividend of 30,000. Now, out of current year, how much dividend they have paid? 20,000. But out of previous year earning also they have paid 10,000. Is it understandable? How much total dividend they have paid? 30,000. Current year income is only. So from where they have utilized 10,000? Previous year. The standard does not distinguish between the two. Okay. So do not over analyze. 30,000 dividend has been paid. What is my share? 80% of 30,000, 24,000. Show by an entry how dividend should be recorded by XYZ. So first you simply calculate the dividend received by XYZ, 24,000, and the simple entry will be bank account debit 24,000 to profit and loss 24,000. No need to make adjustment in investment account even if the dividend is paid out of previous year profit. Okay. So that is about entry in the books of investor. Now when I am preparing CFS, and if the subsidiary has paid the dividend, parent has received the dividend, how am I going to do the adjustment in the CFS preparation? So first we will normally, I have not told you so far, when we prepare CFS, we prepare a statement of either net asset, which will show opening net asset and closing net asset. Net asset on date of acquisition and net asset on consolidation date. Or there is one more way to prepare the CFS by preparing analysis of profit of subsidiary. So either of the two statements we will follow for analyzing the profit of subsidiary. Okay, both are same. only in the statement of net asset we will write share capital also. Okay. Whereas in analysis of profit we'll only write profit and reserves. Rest of the items are same. Now what I'll do, if the subsidiary has paid dividend, I will add back dividend, whichever year they have used that profit. Okay. And if they have paid dividend distribution tax also, that also I'll add back in analysis of profit statement or statement of net asset. Some authors write statement of net asset, some authors write analysis of profit statement, since it is an uneven item. This statement is prepared for analyzing the profit of subsidiary. How much is pre-acquisition, how much is post-acquisition, and making some adjustment in pre-acquisition and post-acquisition. Pre-acquisition will affect goodwill calculation. Post-acquisition will affect the NCI figure and our consolidated reserve figures also. Apply time adjustment if any. After adding this, apply time adjustment if any. Sir, what is time adjustment? If suppose the subsidiary was acquired during the year. Subsidiary was acquired during the year. Subsidiary was acquired on 1st July 2020. Year ending date is 31st March 21. Beginning of the year was 1st April 2020. Which means the current year profit of the subsidiary should be apportioned in the ratio of 3:9. So we have to do the adjustment for the 3 months and 9 months. So you will be given current year profit. But entire current year profit is neither post nor pre. But first you do this adjustment and after that you do the allocation of profit. Sir, why do we do this adjustment first? Because dividend or dividend distribution tax is an uneven item. Which item? Sir, what is uneven item? It is not incurred throughout the year. So therefore we can't apply time adjustment to such items which are not earned or incurred uniformly throughout the year. So if I give the reverse effect of that, if I reverse that entry, now I get profit which is uniform throughout the year. Then you adjust in the time ratio, deduct dividend. Now we have added back at one place, so there must be a contra effect also somewhere. Contra effect will be dividend will be deducted from parent's P&L account and NCI in statement of changes in equity. Similarly, if you have added back DDT here, then you deduct it from the parent's retained earning and NCI in the statement of changes in equity. So this will nullify the effect, because if I add back the profit, I am distributing profit before paying dividend and they have received some dividend. So therefore the total profit received minus dividend is the net increase in the net asset they will get. Profit is before dividend, but I have already paid dividend out of this profit. So to that extent their share will reduce in the profit. And in what ratio we are going to adjust in parent's profit and NCI share? Very simple. Dividend should be deducted to the extent of parent and NCI's respective shares. Like this is analysis of profit. So here I will write add dividend. Add dividend 100. Add dividend 100. And this is SOCIE. In that there is a column retained earning, and one column NCI. 80% share of parent, 20% share of NCI. So we'll reduce it from SOCIE. Now please remember, add back dividend only if the profit given to you in the book of subsidiary is after charging dividend. If they have not deducted dividend, then you don't add back also. Okay. One more adjustment. Institute favorite. Revaluation or change in fair value of identified net asset. This standard is fair value uses fair value approach. So normally when you will acquire a subsidiary, that time this adjustment will be given in almost every problem. Almost every problem, because subsidiaries books are based on historical cost generally. And you have to compute your goodwill, which requires fair value of assets and liabilities. So you will have to increase the fair value of the assets and liabilities. One effect will be in the pre-acquisition. When you increase the fair value on the date of acquisition, the effect of change in fair value, one effect will be given in pre-acquisition. But there may be some items like PPE, intangible asset, which may have a post-acquisition implication also. What is the post-acquisition implication? If you will revalue an asset upward, you have to charge more depreciation in the post-acquisition period. If you recognize an intangible asset in pre-acquisition which is not there in the books of the subsidiary, then you have to provide amortization in the post period. And if tax rate is also given, then you have to also give the deferred tax implication also. So the effect of deferred tax arising on such deferred tax should also be considered. Deferred tax arising on such revaluation should also be considered on the date of acquisition. Some typing error. Effect of deferred tax arising on such revaluation should also be considered on the date of acquisition. So simultaneously you have to give DTA adjustment also, DTA or DTL, whatever. And then don't forget, if you increase the value of a PPE, you will charge more depreciation in the post acquisition period. If you reduce the value of PPE, less depreciation should be charged in the post acquisition period. So post acquisition profit and net asset should be adjusted with any consequential effect of revaluation. For example, if PP is revalued upward, then additional depreciation. If PP is revalued downward, then saving in depreciation, net of tax should be considered. Net of tax means deferred tax implication. And if inventory is revalued, this also remember, inventory can be revalued on the date of acquisition, then cost of goods sold should be adjusted, of course net of tax, if such inventory has been sold during the post acquisition period. Because if you buy inventory and if it is revalued upward, your opening inventory will change. Opening inventory would change, so that will affect your cost of goods sold. That also you need to consider. The problem becomes more and more complicated if there are tax implications also, because for every adjustment there will be a tax implication also. Consolidated SOFP should reflect the above effects. It means all these adjustment first you will do in that statement of profit analysis. Contra effect will also go in the SOFP. So in SOFP what I'll do, let us take the example of PPE. I will add parent plus subsidiary plus increase in value minus additional depreciation. And in the balance sheet asset side, one more item may come, deferred tax asset. So all this effect will also be reflected in the SOFP, whatever may be the effect. So like these are the adjustments which may be possible in case if you revalue an asset upward. In case of downward, again reverse effect. So this standard will test your intelligence, okay? Because so many things we have to consider at a time. Now we will discuss in brief how to prepare consolidated profit and loss. This is much simpler than SOFP, okay? What you will do, you will be given profit and loss account of P Limited, S Limited. So the consolidated will be P plus S. Now here you take care, if subsidiary was acquired during the year, then take proportionate amount only from the date of acquisition. Purposefully they will give you subsidiary was acquired on 1st of December, 1st of November, and you add full number, so then it will be completely wrong. Be careful. Second thing, you have to do some plus minus adjustment also. So simple, P plus S for the time period and some adjustment if required. Like for example, sales of parent is suppose given 200 crore, subsidiary 300 crore. But they have also mentioned that out of 300 crore, 100 crore was sold to the parent. So minus 100. And then write the net amount here. Okay. Cost of goods sold will be adjusted also for purchase, unrealized profit on stock, etc. So all the revenue items will be added on line by line basis. Keep in mind, any intercompany transactions will be eliminated. Like in revenue side, sales from group company will be eliminated. Interest from group company will be eliminated. Dividend received from subsidiary, which will appear in the profit and loss of the parent, will be eliminated. Example I have written, holding company may sell goods or services to subsidiary, receive consultancy fees, commission, royalty, etc. These items are included in sales and other income of the holding company and in the expense of the subsidiary. So we'll have to eliminate it. Reverse can also possible. Subsidiary may sell goods or service to parent company. These intercompany transactions are to be eliminated in full. If there remains any unrealized profit in the inventory of the goods, which we discussed earlier also, or of any group company, such unrealized profit is to be eliminated from the value of the inventory to arrive at the consolidated profit. So this paragraph we have discussed earlier, and immediately after some time we will take a question where this issue will also come. Some important points worth noting. These are not given in the standard. This is what normally teachers add from their own side to help the student. One is P&L account will be consolidated from the date of acquisition. So in some problem, if the date of acquisition is in the current year only, take proportionate figure for subsidiary. Contrast sale and purchase cancellation will be required. Already discussed, even if there is no unrealized profit on stock. Tax expense would be adjusted for any tax effect of unrealized profit. So while calculating tax expense, you may have to calculate additional DTA or DTL. Dividend received within the group will be cancelled. Consolidated P&L account will include effect of impairment of goodwill. Now, impairment of goodwill adjustment you will have to do, because in separate financial statement it may not be there. Impairment of goodwill will come in the CFS. Then you have to make adjustment for additional or saving in depreciation. Additional depreciation for upward revaluation, savings in depreciation for downward revaluation, and if the question gives you tax effect also, tax rate also, do it. Now one more challenge you will have, is to find out the NCI share in the group profit. So NCI share will be calculated based on subsidiaries profit after adjusting for, these are some examples, after adjusting subsidiaries profit. So subsidiaries profit and loss account will be given to you. That will be your starting point. So you can take the profit after tax of subsidiary given in the question and make adjustment for unrealized profit, because in upstream the NCI will have to share that amount. Make adjustment for additional depreciation or saving in depreciation on revaluation. Then also make adjustment for impairment of goodwill, but only when full goodwill method has been followed. That is, NCI is based on fair value method. And do not make adjustment for impairment of goodwill in NCI if partial goodwill method has been followed. Okay. After finding NCI share in the group profit, parent share, shortcut, balancing figure. Is it right? From the total profit of the group, if I can find out how much is NCI share, parent share is the balancing figure. Now, long questions will start. Question number 11 will solve tomorrow. You will try and come 11, 12, 13, 14, 15, 16.